Let's help the Trout family decide whether or not they can retire. You'll recall the Trout family, Brown and Rainbow, and they've got a few kids, but they're grown and out of the home, are looking to decide if they can retire in the next few years. They're both 60 years old, they're still working, and they're hoping that retirement is right around the corner. But the last thing they want to do is run out of money or be forced to go back to work. And at 60 years old, they're thinking about retirement and they're aware that health insurance costs will represent a big cost for them between the time when they retire and when they come on to Medicare, let alone the fact that when they are on Medicare at age 65 for the rest of their life, that the amount of premium they pay based on their current law is based on their MAGI, their modified adjusted gross income. So we're keeping that in the back of our mind as we jump in and start looking at some cash flows. So let's share my screen with you here. We'll jump in, and I think you'll find this to be an insightful discussion. All right, here we are. So you can see the Brown family right now have a 70% probability of success. Let me just jog your memory as to where we're at with them right now. They've got in their situation just over $3 million of total net worth. Now, 750,000 is locked up in their home. And right now, the plan is for them not to sell their home. There's no equity against the home for which they could tap unless they had a HELOC, for example. So if they got a home equity line of credit or a second mortgage. But that's not the plan for them right now. They just want to see what would happen if they stayed put. They do have 2.2 million in investments, and you'll recall that's broken up between $1 million in a 401k for Brown. Rainbow's got a 403b with $500,000 in it, and then an IRA of $500,000 and a brokerage account or a taxable account of 200,000. Then they also have a little bit of cash in the bank there, 80 grand. So what financial planning is getting clear on the data, getting clear on where you're at right now in your situation. And then the next step is to start modeling out some goals. And again, that's where we say, hey, they want to retire at 63. They're looking to spend $8,000 a year on a fun vacation. And in addition to that annual amount, $7,000 a month as living expenses. They also do donate to charity. And for them, they're planning on giving 10% of their income on an annual basis. So this all sits on top of healthcare related costs. So once we've got the cash flows in now, we can model them. So let's come here and I'll show you what that looks like. So we go to the cash flow section and we can see for 2026, the next full year, they'll both be 61. Here's their income coming in the door, 270,000. Living expenses, 84 grand, plus some housing related costs, property tax, insurance, maintenance. Goals, there's the vacation goal of 8,000, and then they donate to charity, in this case 20,000. Taxes, boy, that's a big one for them. They're both working and they're both making the most amount of money they've ever made so far in their lifetime. And that reflects the amount of tax that they're paying. Almost 28,500 in federal income tax, almost 10,000 in state income tax, and then FICA tax, that's Social Security and Medicare tax. Here's their plan saving, both maxing out 401ks, love it. Health savings account, you know how I feel about that one. And they can actually put in more to an HSA than what's showing here. And that was my recommendation. If they're both covered by a qualifying high deductible health insurance plan, then they're both able to do an extra $1,000 catch-up contribution. So it's just over 10,500. They didn't know that they could both do that. We hooked them up with that. So hey, I mean, every dollar counts, right? It's not going to change a whole bunch, just an extra 1,000 going in, but it will save them on taxes. In fact, it will save them in their tax situation. Let's see if we can find their tax rate here. They've got an effective tax rate 13.8 plus state 4.8 and FICA. Boy, they're going to be saving about 25% in taxes. So we're talking about a tax savings of about $250 for the 1,000 that they put into their HSA. And that's just upfront initial tax savings because, as you'll recall, when you invest the money inside of an HSA, it grows completely tax-free. And then down the road in retirement, they can take the money out. Now, this is a good place for us to pause for a moment. And you can see that by them making contributions on a pre-tax basis to their 401k today, they are reducing their tax liability right now and kicking it down the road into those years where they'll be in a lower income tax situation. So check this out. You can see here if they're working right now, 61, 62, they retire at 63. That's a steep drop off. And now all of a sudden, income taxes are very, very low. So it's in these few years where it makes a ton of sense for them to either take the money out to live on, or what would be better is to do a Roth conversion. We'll remove that money from the pre-tax retirement accounts, like the 401ks, the IRAs, to the Roth while their income's low and take advantage of that. Again, with tax planning, there's this idea of smoothing. Tax smoothing is such an impactful principle that most people are unaware of. And it's this idea that we want to take any peaks or valleys and smooth them out, make them a flat surface. And you can see here, we've got a peak, we've got a valley, and then we've got another peak. We're trying to move this income down here and this income off here to the right. We want to shift it down to the left. So we smooth it out. Because instead of them paying a federal tax rate of somewhere in the 12 or 13, 14% range, we prefer to pay it down here in maybe the 10% range. Now, this is effective tax rate. This does not show tax brackets. So let's take a moment and look at this. Effective tax rate essentially takes the tax liability that you owe. So not just what you've been withholding throughout the year, or not just what you have to pay come April, but the total amount of tax that you are subject to for a given year, and divides it by income. So think tax divided by income. Your tax bracket, however, tells you every additional dollar that you earn or that you generate as income is taxed at what rate, and that's what the tax bracket tells us. So here you can see federal income tax rate at 25%. In this situation, we're assuming Tax Cuts and Jobs Act sunsets, and it goes back to Obama era tax legislation. I know the House just recently passed the tax bill that is going to continue on the rates from the Tax Cuts and Jobs Act, but we'll see what happens when the law actually passes. So it may be 25%, it may just be 22% like it is today. So anyways, 25, you can see that's every additional dollar that they're earning or that they generate. If they were to do a Roth conversion while they're both still working, which would be foolish, by the way, but let's assume they both still do it, then that's going to be hit with a federal income tax rate of 25%. Whereas if they waited and they did it down here, well, now we can start to fill up the 10% bracket, and then we would jump up to the next one, which would be 15% in this case. So pretty powerful stuff when you look at it over the course of your lifetime. And again, we're trying to reduce it. Now, you can see they're still in the higher tax rate, or excuse me, the higher tax bracket in retirement compared to what they are when they're working, but their effective rate is now much lower. And the reason that's the case is FICA. You can see this yellow or orange section. This is Social Security and Medicare tax. And this, as you'll recall, goes away when you no longer work because you're not earning income. So that saves on taxes as well. Let me show you something that a lot of people are unaware of. And this has to do with required minimum distributions. Now, before I jump too far, let's say, required minimum distributions tell us a few things. It tells us how much you have in retirement accounts that are pre-tax and how much of that will be forced out when you retire. See, a required minimum distribution is the government forcing money out of your savings accounts, your retirement accounts, requiring you to pay tax on that money so that they can collect the revenue. Now, whether or not you spend the money or you continue to invest it, that's up to you. You can invest it in a brokerage account, for example, but it's got to come out of the IRA or 401k. And the amount that they force out is based on the prior year's ending account balance. So they look at your statement as of December 31st. And then they divide it on a factor based on your age. The older you get, the more as a percentage of your account is to be forced out with required minimum distributions. So let's go here to the retirement section again. We'll go to the cash flow section. And from here, we'll go to accounts. And I want to show you what required minimum distributions are going to look like for brown and rainbow trout. Now, for them, based on their age, RMDs under the current law do not begin until they turn 75 years old. However, if you turn 73 this year, then you have required minimum distributions kicking on. They changed the law a number of years ago, and they have it phased over a period of time based on the year you were born. So for some of you, RMDs will turn on a little sooner at 73. Others of you, it will be 75. And you can see for them, based on the plan and the assumptions we have of their accounts, their IRAs and 401ks growing at a reasonable rate of return, they are seeing $160,000 being forced out in the year 2040. So 15 years from now, 160,000 of which 100% is subject to ordinary income tax. This is income, remember, that they deferred when they put the money into the 401k or when their employer made a matching contribution, which of course was pre-tax, and they are now on the hook to cover the tax. If they move to a state that has a high income tax rate, maybe a state like a California or New York, then they will be subject to state income taxes on this money as well. So just beware. Depending on where you plan to live for retirement, you may be on the hook for taxes. And the opposite is also true. If they move to a state like a Texas or Florida, or maybe a state that has special laws protecting retirement income from being taxable as a way to draw retirees into that state, then there may be some tax benefits to that as well. But let's just say they're going to live in the same place. It's 160,000, and you can see those required minimum distributions are increasing as they get older. In fact, they increase throughout the rest of the plan. Remember, all of that is taxable as ordinary income. You may ask, where does this show up on a tax return? Now, I won't get too nerdy with you, but it's kind of fun to see, I think. So we'll go to 2040, and you can see here IRA distributions. There's that amount. Shows up right here on line 4 of their tax return, and that is subject to taxable to ordinary income tax rates. I also want to bring your attention to something fascinating here. Look at line 6. They don't have any pensions, but they do have Social Security. And right now, when they both file for benefits, and we're assuming they file at their full retirement age of 67, they are going to receive what looks like $96,000, $95,000 and some change, of which $81,000 is taxable as ordinary income. Now, I know there has been talk about them not taxing Social Security benefits lately. We'll see what happens. That's all I'll say. We'll see what happens. I think it's pretty unlikely, but you never know. Right now, under current law, it's taxable. The majority of it's taxable for them based on their situation. So you take the RMDs plus the amount of Social Security that's taxable, and now we're getting to total income. For them, they're doing just the basic standard deduction. There's a few other things in here. This is one that will likely change, standard deduction. We're showing it revert back to Obama-era tax legislation, but it's likely. If I had to guess what your representatives in the House and your senators would vote on, my guess is that this will be a little bit bigger. So maybe for them, it's closer to 30 or 35,000. So they get a little bit of a tax break there. They got a little side business going on. Not a ton happening here. At the end of the day, we're still sitting on $35,000 of tax that they're going to be on the hook for right there. So this is really what's driving the cash flow and kind of the planning for them in retirement. Now, I won't spend too much time teaching you about the 1040. Maybe you're already well aware. Maybe you're just kind of glazing over. But I want you to know that when it comes to real financial planning, it's so important that we understand your tax situation in order to make the best moves for you. When I'm meeting with a client, I want to be really clear on what their tax picture looks like so that I can give them the best advice when it comes to how do we invest, where do we invest, and when you retire, where do we take money out of? Which accounts, which investments are we selling so that we can minimize the tax liability for you over the course of your lifetime? You and I both know it's not how much you make, it's not how big your IRAs and 401ks can get that matters. It's what you get to keep after you pay the IRS. That's really the goal of financial planning. Okay, not necessarily just minimizing taxes. I would say financial planning is all about giving you the peace of mind, the confidence, and the assurance that you can live the life you want to live on your terms. But boy, if you can save some taxes along the way, all the better, don't you think? And by the way, if you're working with a real financial advisor, I would argue that if they're not asking you about your tax situation, you're probably leaving a little bit on the table, because real financial advisors, well, they certainly can help you with managing your investments and helping you generate a good rate of return from your money. They can also do a lot to help you save on taxes along the way. Okay, enough of the pitch on that one. Let's take you over to another section. So we talked about RMDs. I want to show you the cash flows for just a moment. So this shows you their account values at the end of every year. And we've got some assumptions built into this in terms of the rate of return. I like to be conservative, especially on investment returns when we do financial planning. We just don't know what the future will hold. Yeah, the last 10, 15 years have been wonderful for investors. And you've probably made a lot of money. I certainly hope you have. And you've been consistent and disciplined in your investment approach. But if we can be a little bit conservative on those assumptions going forward, then boy, we can be really confident at the end of the day that with those assumptions in place, you don't have to go back to work or stress about running out of money too quickly. So you can see the account values are growing a little bit. Notice what happens here when they turn 63. You can see that the ending account balance in the taxable account, remember this is non-retirement money, money that would be in a bank account or a money market or just an outside brokerage account, it's getting depleted. You can see that eventually it goes away in the year 2030. The reason that's the case is because for them, we can harvest capital gains and capital losses, if there are any, in a very tax efficient way. Remember, there are two large tax systems in the US today. There's ordinary income and capital gain. Ordinary income is taxed at the higher rates. Capital gain gets much more favorable tax treatment. And the income that they're generating from the taxable account in large part is capital gain. So let's just pause and make sure we're on the same page here. When they invest, they're going to have a mix of stocks and bonds and other things within their portfolio, maybe some index funds, exchange trade funds, whatever it is. Stocks produce dividends. Those dividends can get qualifying treatment. They're called qualifying dividends, which means they get the favorable tax rate on them. If you're day trading and jumping in and out, you may not enjoy that and you'll be subject to ordinary income on the dividends. If you hold on to an investment for more than 1 year before you sell it, then you can get long-term capital gains tax treatment. That's the favorable stuff at the lower rates. But again, if you're day trading, jumping in and out as often as you change your underwear, then you're going to be on the hook to pay higher ordinary income tax. For them, a good chunk of this money is invested in stocks. Now, they have some that's in bonds as well. But we're looking for a little bit of growth here, as well as some income to fund those first few years of retirement living, because this is the money that is being used to cover the tax on the conversion and at the same time cover their living expenses. Remember, when they do Roth conversions, when they move money from pre-tax retirement accounts to Roth, they got to come up with the tax money to cover that conversion. And while they certainly could take the money from the IRA or 401k, that would in and of itself generate more income. Let me be clear. If they say take 50,000 out of an IRA and move it to a Roth, and of that 50,000, $10,000 is going to go to the IRS and only $40,000 is going to go to the Roth. In that situation, they really didn't convert 50, they converted 40, and 10,000 was a distribution. See, the IRS says, hey, if you take money out of an IRA to pay the tax, we don't care. Like if you use it to pay the tax or go on a cruise or whatever, that money is now taxable, that 10,000. So just be aware of how that works. Because ideally, you take the money from a non-retirement account to cover the tax on conversion. It's critical for them. They got a few years there now. If they had significantly more in a taxable account, it'd give us a little bit more wiggle room, and we might change up, how we invest the money in the brokerage account. But here we're kind of maybe balanced or balanced growth in our approach. The 401k, this money is invested the most conservatively for them. Now, that's not to say it's ultra conservative or all in bonds, but the reason it's the case, the reason it's holding the fixed income or bonds portion of our portfolio is because it gets this certain tax treatment that it does. Remember, every dollar you pull out of the 401k and IRA, taxable as ordinary income. So if you got stocks in there that you've held onto for much longer than a year and just sell it, it doesn't get you any favorable long-term capital gains tax treatment. You still get hit with ordinary income tax on it, just like you would with bonds. Whereas money in the Roth account, that's the stuff that enjoys tax-free growth. So all else being equal, we want more of the growth-oriented assets for the Trout family to be in the Roth accounts or the tax-free accounts, which would include the HSA as well, and more of the conservative portion in the 401k. Now for them, the lion's share of the money they have in retirement is pre-tax. We're talking over $2 million here between the 401k and IRA that has yet to be taxed by the IRS. And I'm here to tell you the IRS cannot wait to jump on the opportunity to tax that. By the way, worst case scenario, Brown and Rainbow pass away early. Their kids inherit. Within 10 years, all that money's got to be out of the IRA for the kids and taxable at whatever the kids' tax rate is when they take the money out. So now instead of taking required minimum distributions over brown trout and rainbow trout's lifetime, now grayling and the siblings got to take the money out within a much shorter time window. What does that do? That compresses income, spikes it up into the higher brackets, and makes more money for the IRS. And ladies and gentlemen, I'm here to tell you that Secure and Secure 2.0 essentially was a money grab by your government for inherited IRAs. Never before have inherited retirement accounts been so viciously come after now. Whether or not you agree with that, that's a totally different question. But I'm just here to tell you from a financial planning and tax planning standpoint, if your plan is to leave behind some retirement money to kids, then Roth conversions might make even more sense for you when we do financial planning. So instead of just looking over your own lifetime for financial planning, now we're looking at multiple generations. And this is where the magic happens. I talk about it to some detail, some length in my book, Finance on the Fly, Simple Strategies to Build Lasting Wealth. I know you'll like it. Okay, back to where we were here. You can see that the 401k is still growing along with the IRA. It kind of hovers here. Just let's look at the totals off to the right. It kind of hovers around the $3 million mark. It climbs up into the fours. All right, so it gives us a picture of where things are at. Now, you may be saying, hey, wait a minute. I'm looking here, the year 2055, they're both 90. That's how long we've planned for them to live. In this financial plan, they're dying with $4 million. You might say to yourself, hey, I want to maybe leave my kids some money, but shoot, I don't know if I want to leave them $4 million. I want to enjoy it while I'm alive and well, and I want to, this is money I've worked hard for throughout my life, and I hear you loud and clear. But this is a bare bones version of what reality might look like, because in actuality, there are some things that may put pressure on your ability to retire. For example, things like inflation, taxes, or longevity, meaning you live longer than you originally anticipated. And this is where stress testing can be extremely valuable to help you determine whether or not you can retire. With the stress test, we take a look at their baseline right now, and let's just call it 70%. So, of all the scenarios we're testing for them, 70% chance that they retire with 4 million. The 30% is much worse, okay, than the $4 million. And we want to be confident. For me, I like to see it 85, 90% probability of success, and I can feel very, very confident. They're not quite there yet, but I'll show you some things that are pulling it down a little bit. So if the market drops immediately when they retire, it doesn't have a huge impact over their ability to live life. And that's because in that first year or two, they've got cash that they can tap to live on. And they don't have any debt, which is massive, right? Fixed costs relatively low when you don't have a mortgage and you're coming into retirement. But this is a big one for a lot of retirees. Now, I don't know a lot. Maybe we'll see between 20 to 30% roughly. When they retire, the market's down. They've just retired. Now they're pulling money out. We have a fancy, nerdy, I don't know if fancy is the right word. We have a nerdy term for this called series of return risk in the finance space. Don't worry, that's not going to be on the quiz. But it essentially can have a detrimental impact over your ability to retire over the course of your lifetime. Because if you immediately retire right as the market's down and you're pulling those assets out, they will never have the chance to recover because you've spent that money to live on in retirement. Not a big risk for them, thankfully, because of the situation that they're in. Taxes represents a little risk here. If taxes go up or they change dramatically, and taxes would also include things like Medicare costs. Now, that's over here in the healthcare section, similar risk. They're different though. The reason I say Medicare costs is because right now, IRMA, the income related monthly adjustment amount, or in other words, the amount you pay every month for your healthcare premium on Medicare, is based on your income. And I'm here to tell you that there are some changes coming down the road related to how Social Security and Medicare work. Who's paying for them, what they're paying, what the windows and the certain brackets are for Medicare, and that's a risk. So you can see that there. But the big ones are longevity. So in other words, they live longer than we originally expected. Social Security, of course, I don't have to dive into that one with you. Who knows what's going to happen there? Inflation, that's a big one. Because the cost of living, we're assuming, roughly a 3 or 3.5% inflation rate. That's pretty conservative, maybe not in the last few years, but I would say over the last 15, 20 years, 3.5% inflation from year to year, that's fairly conservative. And asset returns, making sure that their investments are growing and working for them appropriately. And one of the biggest things, and it's not uncommon, by the way, to see asset return and inflation as kind of some risks here. The biggest thing that people don't realize is if they live longer, we need to have more assets growing and keeping pace with inflation so that they're there to use when the day comes. I mean, think about it. If, years ago, they used to have take your age, 100 minus your age, and that's how much you should have in stock. So they'd say, hey, 100 minus, let's say you're 50 years old, you should have 50% stock, 50% bonds. If you're 60 years old, you should have 40% stock, 60% bonds. Well, those days are gone, in large part because people are living longer than originally expected. And because people's retirement income is largely on their own shoulders, as opposed to an employer paying a pension for you the rest of your life, and now the risk was on the employer's shoulders. That's really shifted in the form of IRAs, and especially 401ks and other retirement plans coming online, especially in the last 4, 5, 6 decades here. So what this does is require you to have more in stocks or other investments that are growing. Maybe not necessarily just stocks. Maybe it's private equity or private credit or real estate, whatever it is, so that you can keep pace with inflation. So, later on, people came up with articles and they said, all right, it's 110 minus your age or 120 minus your age or whatever it is out there now. That's maybe kind of a decent rule of thumb. But if you're retiring, in this case, they want to retire at 63. If they're retiring at 63, we need to now fund another almost 3 decades of living costs. Boy, that can put some pressure. And if they live 5 years longer than expected, now the success of their financial plan drops to 59.5%. If taxes increase by 20%, so it's not saying that the tax rate jumps up an additional 20%, it's just saying it increases another 20% from where it was before, that puts some pressure. Healthcare costs, if those increase 20%, you can see, I mean, there's a lot of different things we can play with here. Let's just say, hey, what happens if they, instead of living 5 years longer, what if they live 7 years longer? Let's look at this longevity, see what it does. We'll refresh the page here for a moment. Pulls it down, 54.5%. This stress testing is a lot of what I do in the background to make sure that you can retire. And when you make that decision, it can be a little, unnerving for you, maybe a little unsettling, but I can be confident as your financial advisor, assuming we're in that relationship, that you are on right track and that a lot of different scenarios could happen, but you're going to be able to dodge and weave them and tackle them head on. Kind of think of like parameters. We've set some, and as long as reality is within that range, both positive and negative, hey, you can be all right. So maybe it's not necessarily that the stock market's up and down. Maybe it's you live longer, or you have a diagnosis that requires less, requires you to spend less money in traveling, but significantly more in healthcare related costs or medicine or prescription treatment. This is financial planning, ladies and gentlemen. All right. This is a good stopping point for us. We'll pick it back up in another episode. Thanks for joining me today. My name is Rizik. I'm a financial advisor, CPA, and certified financial planner. If you've enjoyed this, you're going to love the book, Finance on the Fly: Simple Strategies to Build Lasting Wealth.
The Finance on the Fly podcast is for educational purposes only. Any ideas presented are not intended to be personalized financial, tax, or legal advice and are provided for informational purposes only. Rizik is not rendering or offering to render personalized investment, legal, or tax advice through this content. Investing comes with risk, including the risk of loss. Consult your own tax professional, financial advisor, or estate planning attorney to perform your own due diligence.